According to this concept, all business transaction will be recorded in terms of money. Only all the transaction will be recorded in terms of money only. When you purchase the machinery is coming in, cash is going out. Both are the monetary transaction that will be recorded. And the customer becomes legally liable to pay for them. When the goods reach to the customer, then only customer is liable to pay to the creditor. Hello my dear students, I am Dr. B.S. Subramania, called by name Dr. B.S.S., Professor in Commerce and Management, Vidhyaashram First Year College, a Temple of Excellence, MYSURU. In this session, I am going to have Fundamentals of Business Accounting, first semester, Unit 1, Session 3 of BBA. You are going to introduce the financial accounting. Here today, I already told in the first session, what is an account? Account is summarized business transaction relating to a person, firm or industry to know the profit or loss. What is transaction? Transfer of property from one person to another person is a transaction. There are two types of transaction. One is called cash transaction, another is called credit transaction. What is cash transaction? Transfer of property from one person to another for a cash is called cash transaction. Transfer of property from one person to another for a promise is called credit transaction. Today, we are going to discuss the concepts and convention of accounting. What is that is? Concepts and conventions of accounting. You move on. Accounting principle. Accounting concepts are business entity concept, money measurement concept, going concern concept, accounting period concept, cost concept, matching concept, realization concept, dual aspect concept, accrual. At least you have to, in examination, it will ask for 15 marks. You have to write about first this heading you have to learn. Then you have to write about 3 or 4 lines about that concept. Next, regarding that is accounting conventions, conventions of materiality, convention of conservatism, convention of consistency, convention of disclosure. We will discuss one by one. Business entity concept. According to this concept, the business is treated as a unit or unity, one, separate from its owner. So we are considering business and the owner, business as one unit, owner as another unit. Creditors another. In other words, the proprietor of a business concern is always we consider to be separate and distinct from the business which he controls. Here, he is saying that business and the owner are two separate. One side as a businessman, one side as a business. So there are two unity, though it belongs to him only, but we say that business one unit, owner another unit. As such, all transaction of the business recorded in the books of the business, although they belong to the proprietor, but they will record it only in the business. Even the proprietor is treated as creditor. Important. Creditor means who gives the benefit. Capital contributed by him. When investment of money is made by proprietor, the transaction are recorded in books of the firm as follows. Cash account data to capital account. The business is receiving the capital cash. Who contribute? The owner. Owner also treated as a creditor. Credit the giver. If the proprietor lives in a building in which he runs his business, then the rent for the part of the building in which he is residing will not be recorded in the books of accounts. So it is not recorded in the books of account. The part of the rent which he related to the business is recorded. So the entire building, assume that for example the entire building belongs to 10,000. One part he is living, which he is paying about 2,500, another 7,500 is paid by the outsider for the business. So business of 7,500 will be considered, 2,500 will not be considered because it is used by the owner. Money measurement concept. According to this concept, all business transaction will be recorded in terms of money. Only all the transaction will be recorded in terms of money only. Only those transactions that are capable of being expressed in money terms are included in accounting records of the only the way all terms, all expression, all the capital here, no, only those all transaction belongs to monetary will be recorded in the business. Credit transaction will not be recorded here, only monetary transactions. Such business transaction which cannot be expressed in monetary term, this is important. Such business which cannot be expressed, when it cannot be expressed in terms of money, will not be recorded in the books. The assumption asserts that money is the only common unit of recording transaction relating to business. In the absence of this common unit, it would have been difficult to record business transaction. Here, all the transaction belong to monetary will be recorded. Other transaction will not be recorded in the what's called the business is considered. For example, good health condition of the chairman, good quality production, etc. are not recorded because they can't be expressed in the terms of monetary. Here, see that good health condition of the chairman, good quality of production, good health condition of the chairman, good quality of the production are not recorded because they cannot be expressed in terms of money, monetary terms. However, purchase of machinery involves monetary transaction, therefore will be recorded in the books. When you purchase the machinery is coming in, cash is going out. Both are the monetary transaction that will be recorded. Going concern concept. According to this concept, an enterprise is regarded as a going concern. An enterprise is regarded as going concern. That means a concern will continue to operate until it enters into a state of liquidation. Liquidation means closing down. Till the closing down, the business is moving on. Throughout the year, it is moving on till it is liquidate. In this context, a business enterprise should be viewed as an entity which possesses an indefinitely longer period of existence. Therefore, accounts of business should not make unnecessary assumption regarding the forced sales value of goods and assets. Accounting period concept. According to this concept, the working life of a business is split into convenient short period called accounting period. The entire period can be split into number of periods to measure the financial result at the end of each accounting period. Profit and loss of account and balance sheet are the financial statement prepared generally to ascertain the financial result. Generally, it will be prepared once in a year, once in 6 months also. The length of the accounting period depends upon the nature of the business. Generally, usually 1 year is considered as an ideal accounting year. It is also recognized by the law and it is compulsory according to the Companies Act. You have to prepare the account once in a year as per the Companies Act. Number 5, cost concept. According to this concept, the asset is recorded at the price paid to purchase at the cost price, and this cost is based on for all the subsequent account year for the asset. When asset is recorded at cost price, the change in the real worth of the asset due to various reasons is not considered, and that means only cost price will be considered, other market price will not be considered at the time of preparation of final accounts. Only the cost price should be considered, market price should not be considered. For example, a concern purchase a building for rupees 1 lakh. whose market value at the end of the year is 1,20,000. The building is recorded at its cost price is only rupees 1 lakh only. Though the market price is 1,20,000, what's the real cost price? 1 lakh. That 1 lakh will be recorded. Regarding explanation to the second point, that the cost concept does not mean that assets are always shown at the cost price year after year. The asset recorded cost price at the time of purchase are reduced by the process called depreciation. Depreciation means fall in the value of the asset. Such assets ultimately disappear from the balance sheet when their economic life gets over. Once a depreciation goes on, assume that the cost of the asset is 10,000. It has a life of 5 years, means every year it goes on depreciation 20,000, 20,000, 20,000. For how many years? 5 years. At the end of the 5th year, the value of the asset becomes 0. Next one, matching concept. The primary objective of a business concern is to earn profit. The major goal of a business is to earn profit. To ascertain the amount of profit, the revenues are matched compared with the expenses. Revenue means incomes will be compared with the expenses. If the revenue exceeds the expenses, if the revenue is more and the expenses is less, then the result is called net profit. On the other hand, if the expenses are more and revenues are less, the net result is called net loss. Thus, matching concept state that to determine the net profit or loss. It is going to see that net profit or net loss. If the revenue is more, expenses are less, it is called net profit. If the expenses are more and revenue is less, the result is the net loss. The revenues earned during a particular period are compared against expenses incurred during the same period. Revenue and expenses are compared. If the revenues are more, expenses are less, it is a profit. If expenses are more and revenues are less, it is called net loss. That will be compared under matching concept. Realization concept. According to this concept, the revenue is considered to be only when the goods and services are transferred to a customer. When the goods are transferred to a customer, then only the realization concept has been taken place and the customer becomes legally liable to pay for them. When the goods reach to the customer, then only customer is liable to pay to the creditor. When the order has come from the customer, it does not mean we receive the money. It's only an order. Then when the order comes and when we deliver the goods to the customer, if the customer pays, then only we can say revenue is realized. For example, Mr. A places an order with Mr. B for supply of certain goods yet to be manufactured. On the receipt of the order, Mr. B manufactures the goods and supplies to Mr. A. Mr. A make payment on receipt of the goods. In this case, the sales has been assumed take place not at the time of receipt of the order, but at the time of delivery of the goods to Mr. A. Order should not be taken as a monetary transaction. Once you receive the goods, it is called monetary transaction. Dual aspect of concept. This is the basic concept of accounting. According to this concept, every transaction has got dual effect, one debit side, one the credit side. For example, when Mr. A, the proprietor of the business, started his business with cash of rupees 50,000 and building of rupees 1 lakh. He started the business with a cash of 50,000 and building of rupees 1 lakh. Then this aspect is recorded to two places, assets account and capital account. The capital of the business is equal to asset of the business. This can be expressed, can be shown in the form of equation. Capital is equal to asset, cash plus building. What is it? How much cash introduced? 50,000. How much building introduced? 1 lakh. Totally how much? 1,50,000 become your asset. That is equal to capital. We know that asset minus liability is your capital. Your asset is 1,50,000. There is no liability. Then capital is also 1,50,000. Capital here introduce, asset introduce, cash plus building, which is equal to capital. If the business increases the asset by borrowing rupees 30,000, then the dual aspect of this transaction affects the equation as follows. Capital plus liability. Capital is how much? 1,50,000. How much borrowed? 30,000. Total asset become 1,80,000, means the capital also 1,80,000. Accrual concept. Accrual means to be receivable. According to this concept, cost and revenues are recognized as they are incurred. When they are incurred, whether paid or not, or earned, whether they are received or not. Once the income is earned, received or not, when the expenses to be paid or not, that means revenue accrue in that year in which they are earned and not in the year in which they are actually received. Once you earn, it will be recorded. Similarly, expenses accrue in the year in which they are actually paid. For example, interest has been paid for 10 months of rupees 10,000 and 2 months interest due but not paid. Totally 12 months interest is there. They already paid how many months interest? 10 months interest. How many months interest to be paid? 2 months. But the expense on the interest for 12 months has been incurred. Therefore, 12 months interest is recorded in the books and 2 months interest is shown as an outstanding on the liability side of the balance. Out of the 12 months, how many months already paid? 10 months. But we recorded for how many months? 12 months. That is, it may be rent for 10 months, add outstanding 2 months, totally 12 months. Whatever the outstanding, that will come on the liability side of the balance sheet. Conventions. The term convention includes customs, traditions, methods, or rules which guides the accountant while preparing the accounting statement. So, the term convention includes, it may be custom, it may be tradition, it may be rules. We say that accounting conventions are followed to make the message contained in the financial statement more clear and meaning to the user. The following are the important accounting conventions. First one, convention of materiality. The term material refers to the relative importance of an item has been or an event. If an item is material or important, it is likely to be equivalent to the user of the financial statement. Therefore, in accounting, let detailed record is made only those transactions which are of considered as a significant to user. It should be important to the user. The accountant need not keep on detailed record of such transactions which are insignificant to user. Only significant will be considered. For example, the cost of loop tools may be material, significant for a small repair workshop, but the same may be insignificant for a large company. That we say that for a small company it will be taken as significant, for a large company it is called insignificant, we say. Convention of conservatism. Conservation refers to a tendency to maintain the same state of affair without a sudden change. In accounting, convention of a conservatism indicates that there has been a practice by the accountants to follow the policy of playing safe. In other words, accounts follow the policy anticipated no profit but provide all prospective losses. This is considered as their prudence and wisdom. So they know that there may be a loss that will be taken into consideration, but generally it will work only for the sake of profit. Convention of conservatism. Example, some of the examples application of conservatism are given. Valuing the stock in trade at cost price or market price, whichever is less. You have to value the stock either the cost price or the market price, whichever is less. Valuing investment at cost price or market, whichever is less. Depreciation is charged on fixed asset, but appreciation is not recorded. Various provisions are created such as provision for bad debt, bad and doubtful debt, which is called RBD, reserve for bad and doubtful debts, provision for investment fluctuation fund. Discount on creditor is not provided. Joint life policy is shown at surrender value instead of premium amount per. So joint life policy will be shown at surrender value, not whatever the premium has been paid. Convention of consistency. According to this convention, it is necessary to follow some permanent rules which are consistent. Permanent rules which are consistent. While preparing the financial statement, the facility of business to compare its current year financial result with that of previous years. You have to compare the current year result with the previous year. If this convention is not followed, then it becomes very difficult to go on comparison result. For example, if once the stock is valued cost or market price, whichever is less, this principle should be followed year after year. Always the stock should be valued either the cost price or the market price, whichever is less, this should be followed year after year. Similarly, if depreciation is charged on straight line method means depreciation remain constant. Depreciation remain constant. The same should be followed year after year. This practice helps in comparison of result of the business and helps in taking better decisions. E.L. Kohler analyzed the consistency into three types. They are vertical consistency, horizontal consistency, dimensional consistency. Vertical consistency. According to this, the same principle, method, practice are followed within the interrelated financial statement of same date. This is vertical. Horizontal accounting to this consistency will help to make a proper comparison of operation of business from one period to another. Dimensional consistency, according to this consistency will help to make a proper comparison of operation between the two firms within the same industry. We have to compare the two firms within the industry. Convention of disclosure. According to this convention, every financial statement should disclose a true and fair view of the facts and figure after in totality. They should be very, very true and should be very fair of the whatever the figure you submit to the customer, to the public, you should have got the reality. Fact should be totality. In totality here refers to that all information significant to the user of financial statement should be disclosed. This can be done either in the financial statement or in the form of footnotes. The disclosed information may relate to the period covered, relating to the period covered by the financial statement or to post balance sheet data. Whatever the information should be reality. So the customer definitely go through your financial statement. It should be it should be true and fair. For example, a business has raised a large amount of loan soon after the balance sheet date. This will affect the financial status of an enterprise. Therefore, this should be disclosed and brought to the notice of the user. After the balance sheet, you borrow the heavy loan. That should be informed to the users of the particular business. Hope I have explained detailedly the concepts and convention. This will come for 15 marks. You go through, you make out the point of all these concepts, all the convention. At least you have to write 3 or 4 lines about that particular point. Definitely it will help you from the examination point of view. They will ask you what's called explain concepts and convention of a business. So you have to mention which are the concepts are, which are the conventions are, one by one. You write one by one note. Then practice the concept, practice the convention. Definitely it will help you from the examination point of view. Hope you understand. We'll meet in the next session with the journal and journal entry. Till then, goodbye. Meet in the next class. Already I told you about the concepts and convention. This is very important. So you go through the concepts and convention. Definitely it will help you from the examination point of view. Hope you meet in the next session with journal and journal entries.